Hi, I'm Jimmy. In this video, we're looking at Tesla stock, ticker symbol TSLA. So this video is part of our Magnificent Seven series, where we're analyzing all 7 companies of the Magnificent Seven. I'll leave a link in the description below for the other companies. Now, in this particular video, we're going to go through the basics of Tesla's business. Then we're going to run through some recent updates. They recently announced earnings, so we're going to look quickly at some of that. Then we're going to look at some key numbers from their financial statements. And finally, we're going to try to come up with the fair value for Tesla stock using methods like the discounted cash flow valuation method and also price to earnings. Now, this analysis is going to be done on the Investors Grow website, where we try to make it simpler to analyze companies and really simple to value stocks. If you want to get access to this website, link in the description below. Okay, now let's jump into our analysis. So as we can see with Tesla's stock here, stock's up about 13% year over year. Now, a lot of that happened when they reported earnings just recently, and the stock was up about 20% when they reported earnings. So that's where a lot of this gain came from. But the big news coming out of that earnings was, if we roll back time back to the beginning of the year, let's say spring of this year, well, this was expected, according to analysts. This was going to be the first year of negative volume increases for Tesla stock. So in theory, they were going to sell less cars this year than they did last year. Also, they were expecting earnings per share to drop a bit. There were a whole bunch of negative revisions from an earnings per share perspective, and they were expecting weaker margins. Well, fast forward to the most recent earnings call where the stock shot up 20%, and pretty much none of that played out. Margins were better than expected. Volume, it shakes out, is going to be slightly positive for the years. Now is what expectations are that volumes will be better than they were expected to be at the beginning of the year. And earnings per share is also expected to see better growth than they expected. So analysts early in the year were fairly off with this, and now things are shaking out fairly good, which would explain the massive jump in Tesla stock. Now, Elon Musk recently came out during that same time and said that he expects volume in 2025 to be somewhere between 20 and 30%. It seems a bit aggressive for me, but this is probably a good segue for us to jump over to the financial section of the website and jump in and look at some of the key numbers. So this is a chart of revenue. So we can see that this revenue chart goes back the past decade. But let's actually toggle on this revenue growth rates option. And we can see that back in 2021, there was 70% revenue growth, then 50% revenue growth, followed by 20% revenue growth. This is where I hesitate a little bit with Elon Musk's 20 to 30%. He's saying 20 to 30%, but since the last completed fiscal year was a 20% increase, you're actually talking probably an increase in revenue growth. And it's very possible, but not easy. Now, I suppose that growth is possible, but a lot of it depends on the new car that they're expecting to release. Now, they haven't unveiled it as of the recording of this video. They haven't unveiled it just yet, but there is some hesitation amongst analysts and amongst some talk on the street that the model, it's called the 2.5 model, is going to be just a revised version of the Model 3. And will that cannibalize sales of the Model 3? How much will it really help overall growth? Because it is possible to increase volume, but if you're doing it at the expense of selling the Model 3, let's say, instead of getting, let's say, new people into the car, that could end up being an issue from a total volume growth perspective. So I think Elon Musk will find out over the next year, but I think his target might be a bit aggressive, but not terrible. I mean, it is possible. They are still a relatively fast-growing company. Now, some of the argument we might hear is that Tesla is more than just a car company. And that's kind of true. But rolling back to the basics of Tesla's business, make sure we're all on the same page. When we jump over to our profile section and then the segment section, well, here we can see a pie chart of where they actually generate their revenue. So in the last completed fiscal year, we can see the light blue section here. Selling automobiles represents 85% of revenue. So while, yes, they do other things, the other two sections there, they are predominantly a car company, albeit a better one, a new one with higher margins. We'll come to that in a minute. But still, at the end of the day, they're selling cars. Okay, but now let's scroll down a little bit And we're going to look at some of the historical trend of just the automotive segment to see how realistic Elon Musk's numbers actually are. So we click on one of the charts here and we look at the history of their revenue. Now, a couple of years ago, the reason for the different colored bars is they actually changed the name of their segments. So we just added both segments to this chart. Now, if we focus for a second just on the purple bars here, well, we can see that growth, automobile sales growth back then was a bit more muted than the blue bars are. So in recent years, it did ramp up. Now, we saw those growth numbers a moment ago, which is why I'm hesitating with Elon Musk's projections. But we can see that in recent years, it has ramped up a lot. So it is possible, just a bit optimistic. Okay, now let's jump out of here and go back to some of the numbers. So back to the financial statement section. And now we're going to look at margins. So margins for a company like Tesla is going to be crucially important. Now, the first thing I would notice here is we can see when they went profitable. Basically, when this number went positive, Tesla went profitable. This is on an annual basis. So overall, we could see these numbers are fairly good. But now let's jump over and look at these numbers on a quarterly basis to see what was freaking out analysts for a while. So when we jump over and we look at these same numbers on a quarterly basis, well, we can see that for a while, outside of that one quarter jumping up super high, but for a while, margin numbers were trending lower. Now, just so we're on the same page, if we were to look at a company like a Ford last year, I think, put up like 2% profit margins. If you were to go to a bit more of a stable company like a Toyota, ticker symbol TM, well, Toyota has high single-digit profit margin. I actually think last year they put up 11%, but on average, they're usually in the 7, 8, 9% profit margins. Tesla, it being a bit more of a higher-end car, is expected to be above that. So this trend lower was freaking people out. But as we can see here in the most recent quarter, they did put up 9% net income margins, which is better than the previous quarter. And it's also better than the 8% or so that they put up the year before of the same quarter year over year. Okay, with that in mind, let's jump over and look at earnings per share. But we're actually going to switch back to annual because I think it's better to keep a bigger picture perspective of a lot of this stuff. And we can see right away, bigger picture perspective, earnings per share is growing somewhat nicely. Okay, now I hate to beat a dead horse here, but when we toggle on growth rates, we can see that growth for a while, earnings per share growth, was going nuts. But in the most recent year-over-year numbers, they were up 17, 18%. Excellent numbers, no doubt about it. But don't forget, Elon Musk is talking 20 to 30% volume growth. So the fact that they're, again, looking to ramp this up, I think is a bit aggressive. We'll see how it all shakes out, but I do think it's a bit aggressive. That being said, let's jump over and look at the shares outstanding to see what has happened to shares outstanding. Are they buying back stock or not? Well, look at this chart here. We can see shares outstanding is gradually drifting higher. This is actually not all that surprising. We generally want to see companies buying back stock, but with younger, faster growing companies, oftentimes that doesn't happen. They issue shares to get additional capital. Now, I do expect this to slow. I don't expect them to do it as often as they get more and more profitable. We can see that compared to early years when they weren't profitable and they needed to raise new capital, shares outstanding would ramp up. But if we're looking for stock buybacks from this company, I think it might be a few years before that happens. Okay, now let's jump over to the estimates section of the Investors Grow website. Again, link in the description below if you want to sign up to get access to this. Well, this is the free cash flow chart for analyst estimates. And we can see the blue bars are historical values. The red line is what analyst estimates were for that particular year. And we can see that analysts have been fairly accurate. There's a lot of analysts that cover Tesla stock, and analysts have been fairly accurate. Their biggest miss looks to be in about 2022, where they were a bit too optimistic compared to what the actual performance was. But we can see with the red line going out the next few years, it looks like analysts overall, on average, are expecting for free cash flow to continue to climb higher. Okay, now let's click on our discounted cash flow section and try to come up with a fair value for Tesla stock. So using those very same analyst estimates that we just saw, that's what this chart is, historical numbers and analyst estimates. Well, we can see that the fair value for Tesla stock only shakes out to be $73 per share using these exact analyst estimates. Now, the reason this might be a bit conservative is with discounted cash flow, the assumption is that at the end of our projection period, so in this case, we're going on 5 years, at the end of that projection period, it grows at our perpetual growth rate. In our case, 2.5%. Now, it might make more sense, instead of dropping off growth right down to 2.5%, to extend our projection years out a bit. So let's drag our projection years out to 10 years, and we can see the fair value jumps up to $112 per share. And to make this chart a bit more readable, let's zoom in to a 5-year chart so we can focus more on the free cash flow numbers, at least the projections. Now, the reason that this is a bit more realistic is the way this website works. So the way really you should do it on your own if you were calculating your own discounted cash flow calculation is, let's illustrate it. Let's jump over to the free cash flow growth rate chart. And we can see that analyst estimates had the analyst numbers growing the final year at 34%. Well, our numbers take the 10-year average and then gradually decline it. So we can see that it goes, 24, and it drops all the way down until the year after our projection period would be 2.5%. Now, this is real important because it really makes the numbers far more realistic from a growth perspective. Okay, now let's jump back to our free cash flow numbers. So now, the big question, the other big pushback that I generally get is my required rate of return is too low. Well, that's actually why we added this line here called implied return. The implied return for Tesla stock right now is 5.66%. So what this means is that if we were to change our required rate of return to the 5.66%, well, that would basically, give or take, have the fair value equal the current price. So if we were to argue about whether or not the fair value, the required rate of return is too high or too low, as you can see, you know what didn't change there? The implied return. The implied return tells us, with our estimates for free cash flow, what will we in theory return? So what is your required rate of return? Is your required rate of return greater than 5.66%? If that's the case, this stock is likely overvalued right now. Now, just to double check ourselves, let's click over on our multiple section to see what this stock would be worth using something like price to earnings multiple. Well, this is a historical chart of price to earnings multiples going back the past decade. And as you can see, it's currently trading in the 60s, which is far too high. Although, yes, it is on the low end compared to their own averages, I still am not comfortable with paying $60-something per $1 of earnings for any stock, despite the fact that their growth is reasonably high. Again, even if we take Elon Musk's 20 to 30%, I don't think that necessarily justifies paying 63 times earnings. So overall, looks like Tesla stock is fairly overvalued. So again, if you want to sign up to get access to this website, I'll leave a link in the description below. Next up in our Magnificent 7 series is Meta. That's the final company in this series. We'll leave a link for that company in the description below once it comes out. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.